If, for instance, if you wanted to purchase a practice that gives you a strategic advantage by giving you a new geographical location, you can do a gradual rebranding over time so that you don't, I guess, alienate the existing clientele of that practice, but let them know that it's under new management, and over time that becomes part of the whole practice over a geographic area. That's why you look at that kind of stuff.
All right, more specifically, what are the pitfalls of purchasing a financial planning practice and purchasing an AFSL or setting up an AFSL? What are you seeing in this space?
Well, that's two pretty different questions. And again, it's what are you buying? Are you buying a book or are you buying a practice?
A business.
So we're buying a business.
Buying a business.
Don't buy based on revenue. You base it on profitability. EBITDA. And it should be based on how profitable is it and how profit has it been in the past, so that we can try to reliably determine what it's going to be worth into the future as well.
What about AFSLs? Does that increase the valuation because you have more choice in able to determine the suppliers and potentially reduce your risk?
Potentially. The answer is potentially, and I think it all comes down to the relative risk, relative reward for the business. Because if your business is not big enough, the compliance cost, the regulatory frameworks that sit around having your own AFSL means that your cost of compliance could be proportionately too high, and it might be better to simply take on someone else's AFSL. However, that freedom that sits in and around the ability to choose your products, not being kept in a rigid framework of saying these are the products that we will allow you to recommend, and allowing you to therefore essentially give real financial advice that is based upon the specific needs of the I guess the purchase of the client.
What about the integration of advisory practice with accounting? Does that somehow multiply the value of the business?
As a cohesive business. So a lot of the time we see firms have financial planning and accounting under the one brand, but they're siloed. There's very little collaboration between the two, and we're wondering if you have a really good, successful integration between the two, does it actually add value to that overall valuation of the practice, rather than as a way to stop client leakage, stop clients leaving because they might go to another integrated firm?
Short answer, yes.
Great.
So really what it comes down to is if you can have multiple income streams for any business, it reduces risk, and therefore
makes sense.
Increases the value. It's just how it is. I mean, if I have a downturn in my income from my accounting firm, then at least I know that I have the income from my financial advisory firm, and vice versa. When you have two complementary businesses such as financial advisory and accounting that sit together under the same or very similar branding, they're able to leverage off each other. And it's, again, that word synergies. If you can find synergies between those two businesses.
So more income for the same client base, basically.
Essentially, that's what it can be, but also...
But do you have to push the two of the businesses to come and come under one business goal and objective, come together? Like, often we see them completely separated. We were out into regional New South Wales last year, and we saw a firm with 25 accountants. They had 5 financial planners. They didn't even know they didn't even know what the financial planners did, and it was astonishing.
The people down the end of the office.
And they said they've got these weird people at the back of the office. We don't know what they do. They give some type of witchy financial advice, and I thought that was absolutely astonishing on how they have viewed that financial planning aspect of their business. It's not the accounting. The accounting was much larger, but I thought if you actually spent the time to build both of those, you must be able to have a more profitable client relationship, better business, better processes, and a better combined marketing, brand awareness that will eventually lead to a bigger goodwill.
Yeah. Well, look, my main clients are accounting firms. And so I've got hundreds of accounting firms across the country that refer work to us, and we are obviously in conversations regularly. What I see in what you've just discussed is probably a failure in strategic management,
strategic planning,
and like just the leadership element there to say, look, we are one business. We're pulling in the same direction.
Yeah.
An accounting firm is there to help individuals and businesses to ensure that their tax compliance is in place and that kind of thing. But it should also be delivering advisory services to help them build their business wealth, the way that the business operates and the income it generates. The financial advisory side of things should work perfectly together in harmony to say, right, we've developed all of this, we've minimised your tax as much as is possible, but now how does that translate to personal wealth growth?
Yeah.
And having that conversation between the different business elements means that all of a sudden you have an end-to-end product that you can offer to your clients to say, okay, we're going to look after your taxes, we're going to look after making sure that you're compliant with everything that you need to be compliant with, and we're also going to give you strategic advisory services in and around your businesses and that kind of thing. But now, how do we get that money and build you wealth for an early retirement, whatever your objectives might be?
Are you seeing just specifically a lot of those firms, 100 odd ones you have in your network, not actually properly integrating those two to help in tax and then personal wealth growth?
I think it is
Emerging.
It's more so that there's several within that group that are doing it extraordinarily well.
Really? Okay.
And they are the standouts to me.
But it's the exception, not the rule.
Correct. And I think that comes from, this requirement that we were keeping our financial advisory and accounting practices so separate for so many years because of the requirement that you needed to be able to give financial advice.
Do you think it's also the risks? A couple firms have said to us that they wanted to keep their financial planning and accounting siloed because the risks in financial planning, especially after the Royal Commission and the changes of a lot of these accountants were at big licensees, dealer groups that went through 3 or 4 changes, and they like to keep it siloed because in case it fell through, the financial planning, it wouldn't impact so much the accounting.
Look, structuring a business and structuring your entities is very different to the brand of those different businesses. You can quite easily have 2 silos that still share a marketing database or that speak to each other and cross-refer. I mean, your accounting clients should be given the information that you do have the ability to help them with their personal wealth in this other branch of the same sort of entity. They aren't the same business. They're 2 separate businesses. They might be sitting in 2 separate companies. They might have a similar ownership or whatever it might be. But it doesn't mean that they should not be interrelated with regard to offering services to clients.
Yeah.
It's those aspects of risk with regard to each entity exist no matter what. So, of course, structuring is important. But making sure that you can deliver services to the people who need them, that's the most important thing here. And that's why we're sort of on this bent. We're trying to give the best possible service to the client. And I think sometimes we lose sight of that and we're too busy trying to, as accountants, we can be a bit risk averse. And therefore we try to take the path that will reduce risk the most.